Welcome to an exploration of the groundbreaking changes sweeping across our financial world. We are witnessing an unprecedented convergence of traditional finance with innovative digital technologies, driven by a rapid pace of change and an urgent need for efficiency and accessibility. This is not just about new investment opportunities, it's about the very infrastructure of money and wealth. At the heart of this transformation lies the concept of digital money, particularly stable coins. Traditionally, any tokenized asset backed by a legal tender currency could be called a stable coin. However, the regulatory landscape is rapidly defining what truly constitutes electronic money in the digital realm. For a stable coin to be considered electronic money, it increasingly needs to be issued by a regulated entity, such as an electronic money institution or a credit institution. This distinction is crucial, as it determines whether a digital asset functions as a mere medium of exchange or can be treated as legal tender for payments and taxation purposes. European regulations, for example, have introduced strict frameworks for stable coin issuance. These regulations often include volume and market capitalization thresholds. If a stable coin exceeds these limits, it may be subject to intervention, or even a panic button from central banks, to prevent it from posing a risk to monetary sovereignty or financial stability. This demonstrates a cautious approach from regulators, often driven by a perceived fear of new, large-scale digital monetary phenomena. Despite these challenges, the interest from traditional financial institutions, particularly banks, in issuing their own stable coins is growing. Initially, this interest is often focused on internal mechanisms for cost reduction and efficiency enhancement in operations, such as intergroup settlements. However, the broader potential for payments, especially in areas like remittances, is undeniable. The demand for well-regulated stable coins is projected to see enormous growth, with estimates suggesting a 114% increase between 2025 and 2030, highlighting a silent but pervasive adoption into retail and institutional economies. Beyond stable coins, another revolutionary concept is the tokenization of financial instruments. This refers specifically to converting traditional financial instruments, like stocks, bonds, or units in collective investment schemes, into digital tokens on a distributed ledger technology, DLT, or blockchain. This innovation targets the antiquated back-end systems of traditional financial markets, which are characterized by multiple intermediaries, high costs, and time delays for settlement. Europe has been a pioneer in this area, establishing a DLT pilot regime. This regulatory sandbox allows market infrastructures to experiment with blockchain technology, offering exemptions from traditional financial market rules. The goal is to innovate and discover how DLT can drastically improve efficiency, reduce reconciliation times by up to 70%, and cut user costs by 50%. The ultimate aim is to achieve T0 settlement, instant delivery versus payment, which is impossible with conventional money. This requires both financial instruments and the money used for settlement to be tokenized, underscoring the critical need for regulated stable coins. This pilot regime has been so successful that, within just 2 years, regulators are already recommending its permanent implementation. This signifies a clear shift towards a future where financial markets operate on DLTs, offering 24/7 availability, greater liquidity, and a truly international scope. Fintechs and even some traditional market players are actively exploring or already developing these new infrastructures, anticipating a future where the current physical and geographical limitations of financial markets are dissolved. A fascinating development in the digital finance space is the strategy of incorporating Bitcoin into corporate treasuries. This approach involves companies using their liquidity, or even debt, to acquire and hold substantial amounts of Bitcoin as a primary treasury asset. The rationale behind this strategy often stems from a belief in Bitcoin's scarcity and its potential as a long-term store of value, especially in an inflationary global economy. This strategy can be financed through various traditional financial instruments, such as convertible bonds or perpetual preferred shares. The goal is to constantly increase the amount of Bitcoin per share, benefiting shareholders from the asset's appreciation. Proponents view Bitcoin as a black hole, absorbing fiat currency, a deflationary asset in a world of ever-increasing money supply. However, this strategy is not without significant risks. Companies adopting this model often see their valuations become highly correlated and even more volatile than Bitcoin itself. It demands a deep understanding of both financial markets and the cyclical nature of digital assets, as well as a transparent communication strategy to the market. There's a concern that some attempts to replicate this model, particularly by companies lacking organic growth, could resemble past speculative bubbles, such as the eco-boom, leading to significant investor losses. While the potential rewards are high, the all-in nature of this approach requires extreme caution and a robust financial framework to manage the inherent volatility and regulatory complexities. The rapid advancements in digital finance necessitate robust regulatory frameworks. Two key European regulations are MiCA, Markets in Crypto Assets, and MiFID, Markets in Financial Instruments Directive. MiCA specifically governs crypto assets and related services. It addresses the issuance of stable coins and the provision of crypto asset services like custody or exchange. Its implementation has been challenging, as it requires applying new legal definitions to evolving business models, forcing companies to seek specific authorization to operate. MiFID, on the other hand, regulates traditional financial services and markets. The intriguing development is the convergence of these two. Fintechs and neobanks are increasingly seeking both MiFID and MiCA licenses to offer a hybrid suite of services, combining traditional financial instruments with crypto assets on a single platform. This combo winner approach allows them to provide comprehensive digital investment opportunities. This regulatory evolution is creating a competitive race between traditional banks and agile fintechs. While banks possess vast resources and established regulatory relationships, fintechs often demonstrate greater agility and a culture geared towards innovation. The first movers in adopting these new regulatory paths, especially those securing electronic money institution (EMI) licenses, gain a significant strategic advantage, positioning themselves to capture new market share, particularly from younger generations who are already deeply engaged with digital platforms. In parallel with private sector innovation, central banks globally are exploring central bank digital currencies, CBDCs. However, the adoption and potential impact of CBDCs raise significant concerns. Critics often express skepticism about the true rationale beyond political rhetoric, highlighting potential issues such as increased banking disintermediation, which could negatively affect traditional banks. More broadly, concerns revolve around the implications for financial privacy and control. CBDCs could potentially enable real-time taxation and greater governmental oversight of transactions, leading to fears of reduced individual financial autonomy. This centralized approach contrasts sharply with the ethos of many in the digital asset space who prioritize self-custody and invisible wealth, assets held in a manner that is less traceable and subject to third-party control. The very existence of CBDC initiatives, by drawing attention to the potential for centralized control, paradoxically fuels the demand for privacy-enhancing technologies and decentralized alternatives. The ongoing financial revolution is fundamentally altering how we perceive and manage wealth. We are moving towards an era where invisible wealth, digital assets held in self-custody, less ostentatious and often outside traditional financial systems, is becoming increasingly prevalent. This shift is partly a response to concerns about privacy, governmental oversight, and the devaluation of fiat currencies. Many now view digital assets, particularly highly scarce ones, as a form of vital energy insurance against the erosive effects of inflation and continuous monetary expansion. This perspective suggests that in a world facing economic challenges and persistent fiscal pressures, assets that are scarce and difficult to control by centralized authorities gain significant appeal. The integration of digital assets into the mainstream financial system, allowing them to serve as collateral for loans or guarantees for tax deferrals, is crucial. This would empower individuals and businesses to leverage their digital wealth without having to sell it, providing greater financial flexibility and reducing the need for traditional liquidity events. The ongoing innovation in financial products and services around digital assets indicates a future where the current generation's financial needs will be met by solutions far more efficient, accessible, and aligned with a digital-first lifestyle than what traditional banking currently offers. The speed of change is breathtaking, and the opportunities for those who understand and adapt are immense. From the redefinition of money through regulated stablecoins to the complete overhaul of financial market infrastructures via tokenization, and the evolving corporate strategies around digital assets, the financial future is being built now. It's a complex, dynamic landscape, but one ripe with potential for those willing to engage and learn. Thanks for watching, and remember to like and subscribe to stay updated.